Welcome back. Markets, of course, 100 points higher, 22,500 still. Let's welcome in Nikhil Ranka, who's with us now, CEO of Equity Alternatives at Nuvama Asset Management. Nikhil, of course, has become more constructive over the last few interactions we've had. Nikhil, what will it take to get out of what you call it? I don't know what to call it, escape velocity. to really nothing. I mean, I'm not expecting anything fast-paced, but at least, prices should start to move, right? You buy, you hold, and not maybe price-wise bottom is made, but you need some momentum here.
So good afternoon, Prashant, and thanks for having me on the show. So if you look at the last 8-10 years, Prashant, this 10 to 15% drawdown has been a phenomena that has been happening every 2 years. So if you look at 2016, we had the Brexit excuse. 2018 was Ireland FS crisis. 2020 was COVID. 2022 was the Russia-Ukraine war. And now we had this Trump tariffs and FI outflows, which have caused this correction. Now, if you typically look, except for COVID, the levels at which markets have made a durable bottom, it has been between 16.5 to 17 times 1 year forward earnings. That's where typically markets have bottomed out over longer time frames. Today, as we said, if you look at our FY27 consensus estimates, we are at closer to 1350 levels. And therefore, we have more or less got to that 16.5, 17 times earnings level. If you look at it, two more things that will make constructive is first, in terms of leverage. If you look at it, the sort of futures positioning is down almost 35% from the peak. So one good thing is that clearly the market is very light now. And to top it, in terms of valuations, if you look at India's premium to MSCI emerging market, we were at closer to 75-80%. We are now down in the 50s. And the most important point is, after such a sharp fall, Prashant, the first signs that stability is returning to market is where you see the intraday gyrations come down substantially. So, February was a month where we had so high intraday volatility. As we have moved into March, we have persistently seen that the volatility on a daily basis has started to come down. Which gives a lot of confidence to market participants once you see this range contraction happening. So my sense is price-wise definitely at closer to 2100, we've made a bottom. We should start heading up from here. 22,800 is a level where, a lot of quant funds, all those people who would have gone short on the markets because the FI positioning on the markets is extremely high. It's almost close to 28,000 crores on the index futures. So they would be looking out for that levels, and once market crosses 22,800, I think momentum will come back in the markets post we cross that levels.
After 22,800, to Prashant's point, and Prashant's following Gordon Gekko, right? He's like, enough of this now, waiting and all of that. We want momentum to come back. We want things to start rising again. And Nikhil has clarified that 22,800, which is not too far away from where we are. So, get the animal spirits back up. But Nikhil, since we're talking about the market, getting fired up, and you seem to be convinced that momentum is just a matter of time, let's talk about the one sector that you're quite optimistic on, interestingly, and that is oil marketing companies. Now, is that a tactical trade that you're advising at this point in time, or is that a bit of an investment call? Crude oil is down, we know that, and it's unlikely, God forbid, if there's another war or some escalation again, which shouldn't really happen, that's not on the charts at all. But is that the call, that oil will stay down and therefore this is a more medium-term investment call, or is it just a tactical trade for you right now, OMCs?
So I would say two things over here. One, if you look at it, one of the reasons why we are constructive on OMCs is if you look at the decision of OPEC, they have said that from April onwards, they want to again increase the production quota for respective countries. Given the backdrop that the demand growth is still less than 1%, and if we have supply increase coming through, then clearly the marketing margins, which are currently at elevated levels, will sustain. So if you look at the current gross marketing margins, on petrol, we are somewhere close to 10 rupees. On diesel, we are somewhere close to 7.5 rupees. So notwithstanding the fact that OMCs are making some losses on LPG, However, given the supernormal marketing margins that these guys are making, my sense is FY26, if crude price stays here, should look substantially better. Even on GRMs, if you look at it, the Singapore GRMs are hovering around $4.5, $5. But the point to remember here is the component of diesel in Singapore GRMs is much less than 20%, whereas most Indian refineries have more than 40% diesel in their slate. So therefore, the margins of Indian refineries will be higher than what Singapore GRMs is projecting. Therefore, my view is that the earnings momentum will be there for OMCs as we head into the next 2-3 quarters. And finally, if you look at valuations, most OMCs are trading at less than 5 times EV/EBITDA on FY26 basis, whereas the average has been somewhere close to 6.5, 7 times. So I think there is a 25-30% opportunity there on OMCs with very little downside from current levels. And so I think investors could look at that sector.
Hey, set up favorable for a 25 to 30% up move in oil marketing companies. They've already started moving. Just this month, HPCL, BPCL are up 10%, though they're still down 30% from their recent peak. Let's talk about IT, Nikhil, since you look at IT very closely. And I remember from our past conversation, you've been a bit cautious about IT. But now you're seeing, trouble brewing in the IT sector. There is worry about discretionary spending not picking up as expected, tech budgets continuing to remain under pressure. Your thoughts on IT post the recent correction and IT versus banks, since both of them are in the FI books?
So, Rima, coming to IT, I think what is concerning the street is given the sort of tough macros that even US is going through because of the tariff policies. Even on US markets, we've seen significant volatility in that sense. Dow is also down 9-10% from the peak. As we head into Q4 results, everybody will start watching out for what is the guidance from IT bigwigs for FY26. My sense is given where things stand a lot and the fact that they are not seeing major pickup in discretionary spending, as we start the year, the guidance could be a bit muted, and then as things fold out, companies could increase guidance through the year. But the fact that initially as we move for the first guidance for FY26, there could be some sort of disappointment. That is what is, I think, getting the street a bit discomforted that ultimately it could still be another year of single-digit earnings growth for most IT names. Because of that, I think the earnings cut could be less than 2-3%, but multiples clearly are getting derated. If you see at some of the larger names, which used to trade closer to 25, 26 one-year forward earnings, that is now almost down to 20 to 22 times one-year forward earnings. So I think it's more because of growth slowdown, multiple derating that we have seen in a lot of IT names.
Nikhil, I think you like banking as a space, right? But I think we've discussed that. IndusInd, any views? And trading
I think, Prashant, specifically on the quantum of losses, I think that's a well boxed out problem. We all know the number is out in public domain of close to 2,100 crores. And even after taking that hit, the management has clearly indicated that they would be profitable even for the current quarter. So capital adequacy doesn't seem to be a challenge for the bank. The only thing that probably markets want to see is what sort of deposit outflows does the bank sees over the next 15-20 days? Because ultimately banking is a leveraged business. You have capital adequacy of 15-16% and you have lent out 100 rupees. So if you have withdrawals more than 8-10% of the deposit base, then obviously it gets into some sort of liquidity crisis for the bank. And to that extent, I think the move from RBI was very good. Immediately they had come clarified that should assuage some of the nerves of depositors that everything is good for the bank. My sense is over the next 10-15 days, investors will closely watch out for the liquidity situation. And if the deposit outflow number is not very high, then obviously the stock should get back on its feet. Because valuations are very lucrative. The stock is trading at now closer to 0.7 times FY27 books. So I don't think valuation is a concern over there.
But we'll know that when deposit outflow. I mean, there's
So typically, quarter end is when most of the banks will come out with their sort of quarterly update numbers. And we will get a sense if they give the quarterly update as to what sort of outflow numbers they have seen. Because whatever weak depositor hands had to get out, by that time we would have seen the bulk of it. So if that number is not very bad, then obviously things will start changing for the bank from the first week of April onwards.
Okay, and of course, I mean, RBI timely communication, and maybe hopefully after that, that should be limited in that sense. Nikhil, we leave it there for now. Thank you very much for joining us and running us through your views right now on a variety of subjects. Well, we take a quick commercial break. As always, we'll get you a check on what's happening in